Imagine the symbol of absolute safety that the world has trusted for more than 80 years suddenly collapsing in just 48 short hours. This is no longer a warning buried in research reports or a headline designed to shock. It is a financial breakdown unfolding in real time, assets once considered beyond question. U.S. Government bonds and gold stored in vaults in New York are now being openly re-examined by the most conservative institutions in the world. What we are witnessing is not volatility, but the erosion of trust. Before we examine why this is happening and what it means for the global system, welcome to GE Economy, where we deliver in-depth analysis of economics, finance, and market cycles. Don't forget to like the video to support the channel and subscribe to receive more valuable insights. That loss of confidence did not remain abstract for long. It translated into action by the most risk-averse capital pools in Europe. Denmark moved first. In June 2025, the Danish pension fund Academic Pension announced it would exit U.S. government bonds entirely by the end of March 2026. This was not a routine rebalancing or a marginal trim. It was a full withdrawal. The fund's investment committee stated plainly that U.S. federal finances no longer met the definition of long-term sustainability. Days later, Sweden followed with a quieter but equally decisive move. Throughout 2025, Alecta, one of the country's largest pension managers, sold between $7.7 and $8.8 billion worth of U.S. Treasuries, deliberately spreading the sales to avoid market disruption. Then came Germany. Senior politicians publicly renewed demands to repatriate approximately €113 billion worth of gold stored in vaults beneath Manhattan, gold that had remained overseas since the Cold War. These decisions share a single underlying logic. Institutions built to protect capital, not chase returns, concluded that political uncertainty, rising debt levels, and declining fiscal discipline in Washington now represent structural risk. When Europe's most conservative stewards act in unison, it signals not panic but a verdict. These decisions were not driven by fear or short-term market swings. They were acts of survival. Europe's pension funds and sovereign institutions did not exit U.S. assets because yields were unattractive, but because political risk had become measurable. By 2024, 2025, analysts inside these institutions began treating policy, unpredictability, sanction exposure, and executive interference as quantifiable threats, risks that could not be hedged with duration or diversification. In effect, the definition of safe had changed. The logic mirrors a familiar behavior seen in countries like Turkey during periods of currency stress. When confidence in institutions weakens, households do not chase higher interest rates. They withdraw savings and buy physical gold. The difference here is scale. Instead of families protecting savings, entire nations are protecting balance sheets worth hundreds of billions. The priority has shifted decisively toward assets that are tangible, jurisdictionally controlled, and immune to sudden political repricing. Gold stored domestically, cash held within national systems, and reduced exposure to foreign custodians have become strategic objectives. This is why central banks accelerated purchases, even as prices rose. According to the World Gold Council, central bank gold buying reached multi-decade highs in 2023 and remained elevated through 2024. These moves signal a deeper conclusion. When assets can be frozen, sanctioned, or weaponized overnight, yield becomes secondary to sovereignty. This is not panic, it is preparation. This defensive shift did not emerge in a vacuum. It was catalyzed by what analysts increasingly describe as the Trump effect, a series of political actions that transformed abstract risk into immediate, priceable threat. The first shock came with repeated public suggestions, beginning in 2019 and resurfacing again in later campaign rhetoric, that the United States could acquire Greenland. For Northern European governments, this was not a joke, but a direct challenge to sovereignty and regional stability. Confidence eroded further as pressure mounted on the independence of the Federal Reserve. Open attacks on monetary policy and personal threats toward Jerome Powell signaled that the world's most important central bank could be subordinated to political will. At the same time, renewed tariff threats and trade actions against Europe reintroduced the idea that economic relationships could be weaponized overnight. The cumulative effect was decisive. By late 2024 and into 2025, U.S. policy was no longer viewed as rules-based, but as discretionary and unpredictable. For the first time, investors began pricing political volatility directly into U.S. Treasuries, not just into equities or currencies. This marked a structural break. When sovereign debt depends on political temperament rather than institutional continuity, it ceases to function as a neutral anchor and becomes a contested asset. Once political risk was openly acknowledged, the final taboo of global finance collapsed. For decades, questioning the sustainability of U.S. government finances was unthinkable, especially for conservative pension funds tasked with protecting long-term liabilities. That silence ended in 2025. European institutions managing hundreds of billions publicly concluded that U.S. fiscal dynamics were no longer sustainable. This was not speculation but fiduciary judgment. With that admission, U.S. Treasuries quietly lost their unique status. Instruments once treated as risk-free began to be analyzed as ordinary sovereign debt, exposed to deficits exceeding $1.7 trillion annually and debt levels moving beyond $34 trillion. The impact was psychological before it was financial. Once the unspoken rule was broken, capital constraints dissolved. Risk committees that had never modeled U.S. stress scenarios were suddenly required to do so. This shift did not trigger panic selling but something more dangerous: permission. When tradition no longer restrains decision-making, exits become rational, coordinated, and systemic, marking the beginning of a capital reallocation that no longer assumes American debt is immune to doubt. With that taboo broken, history begins to rhyme, and the parallels lead straight back to the 1970s. The last time America's allies openly questioned the credibility of the dollar was under Richard Nixon. By the late 1960s, mounting U.S. deficits from the Vietnam War and domestic spending pushed foreign governments to doubt whether the dollar was still fully backed. In response, countries such as France and Switzerland began demanding the conversion of their dollar reserves into physical gold. That pressure culminated on the 15th of August, 1971, when Nixon abruptly closed the gold window, an event later known as the Nixon shock, which effectively ended the Bretton Woods system. The aftermath was severe. A decade of high inflation, currency instability, and a surge in gold prices throughout the 1970s. What makes today more dangerous is scale. In 1971, U.S. federal debt stood below $400 billion, under 40% of GDP. Today, it exceeds $34 trillion, with annual deficits running above $1.5 trillion. If foreign confidence weakens again under these conditions, higher borrowing costs and monetary intervention could reinforce each other in a self-destructive loop. History shows that once trust in the system erodes, restoring it is neither quick nor painless. That historical parallel matters because Europe is not a peripheral observer, it is one of America's largest creditors. Today, European investors hold approximately 3.6 trillion in U.S. government bonds, representing close to 40% of all foreign-held U.S. debt, according to data from the U.S. Treasury Department. But treasuries are only part of the exposure. When equities, corporate bonds, and other financial instruments are included, Europe's total asset exposure to the United States approaches $8 trillion. This creates a tightly interwoven financial matrix in which even small reallocations carry outsized consequences. The danger lies in marginal movement. A shift of just 1% of that $8 trillion, roughly $80 billion, would represent a liquidity shock large enough to push Treasury yields sharply higher in a short period of time. Higher yields, in turn, raise borrowing costs for Washington precisely when refinancing needs are accelerating. This is why European decisions are monitored so closely in U.S. policy circles. They are not symbolic gestures, they are mechanical pressures. When a creditor of this scale begins to question sustainability, the issue is no longer confidence alone, it becomes arithmetic. Europe's repositioning would already be destabilizing on its own, but a second pressure point is now emerging from Asia, Japan. In early 2025, yields on Japan's ultra-long government bonds surged, with the 40-year JGB climbing above 4% for the first time on record. For decades, Japanese investors accepted near-zero returns at home and deployed capital abroad, particularly into U.S. Treasuries. That incentive has now reversed. As domestic yields rise, Japanese insurers, pension funds, and banks have a rational reason to repatriate capital rather than assume foreign political and currency risk. The timing is critical. Japan remains one of the largest foreign holders of U.S. government debt, alongside China and European institutions. When Japanese capital begins flowing home at the same moment Europe is reassessing exposure, the U.S. Treasury market faces pressure from both sides, Atlantic and Pacific. This is not panic-driven selling, it is yield-driven reallocation. Reduced foreign demand forces the U.S. to offer higher yields to clear the market, raising borrowing costs just as refinancing volumes accelerate. Europe's doubts and Japan's incentives are independent. Yet together they tighten the liquidity vice around U.S. sovereign debt. In bond markets, simultaneity is risk, and this convergence is precisely that. As pressure builds from both Europe and Japan, gold has moved back to the center of the global financial system. This is not a speculative shift, but a strategic one. According to the World Gold Council, 43% of central banks worldwide expect to increase their gold reserves over the next 12 months, the highest share ever recorded. The motivation is clear. Unlike sovereign bonds, gold does not depend on the fiscal discipline of any government. Unlike reserve currencies, it cannot be frozen, sanctioned, or politically weaponized. And unlike paper assets, it carries no counterparty risk. This is why central banks continued buying even as prices reached record highs in 2024 and early 2025. Gold is no longer treated as a passive relic of the past, but as an active form of insurance against systemic failure. When confidence in fiat money weakens and geopolitical risk enters balance sheets, gold becomes the asset of last resort. Not because it promises growth, but because it promises survival when trust collapses. The conclusion forming from these developments is clear and increasingly difficult to ignore. The global financial rulebook is being rewritten. For most of the post-World War II era, the United States functioned as the default destination for safety. U.S. Treasuries were treated as risk-free, the dollar as neutral, and American institutions as politically insulated. That framework is now breaking down. By 2024-2025, global capital flows began reflecting a new priority set, one that places political predictability above yield. Investors managing trillions of dollars are no longer asking whether U.S. assets offer the best returns, but whether they expose capital to sanction risk, policy reversals, or institutional interference. This shift is measurable. Foreign participation in U.S. Treasury auctions has weakened, while central banks increased allocations to gold and domestically controlled assets despite higher prices. Capital is no longer optimized for growth, it is optimized for survivability. History suggests that such transitions do not happen overnight, but they are rarely reversed once underway. The early movers are always the most conservative institutions, the ones with the least tolerance for uncertainty and the longest liabilities to protect. What we are witnessing now is only the opening phase of a broader realignment. As pressures compound and precedents are set, others will be forced to reassess whether remaining passive is riskier than acting. The unresolved question is no longer if the old assumptions will fail, but which major holder of dollar-based assets will move next, and how large that move will be. Is this the start of a systemic shift, or merely the first crack in a much larger structure? Thank you for watching the video. If you have a different perspective, feel free to share it in the comments below.